Hello, everybody. Welcome to the Trading with Ashley show. I know these markets are really rough right now. It doesn't matter if you're an option buyer or an option seller or just a buy and hold investor. Seeing your portfolio dip and continue to dip is never fun. But I did want to explain to you that if you're an option seller and if you are stuck in sold puts that are underwater, meaning the current price action is well below your strike price, there is something you can do. One of the risks when you're an option seller is early assignment. Now, if you have an expiration date that's a few months out from now, usually you don't have to worry about that quite as much. But early assignment does happen about 7% of the time. And it's more likely to happen with an elevated VIX like what we have going on now. Because who's ever on the other side of that trade, they get nervous or they may want to clean up their portfolio and help reduce their margin risk. So they may go ahead and close out their position, and then you're stuck at a very high level with the stock that you didn't intend to have at such a high level. So one thing I have been going over with my students and how we have been cleaning up our portfolios are we are rolling out to further dates. Sometimes we'll stick with the exact same strike price just to reduce the risk of early assignment. And sometimes if we can get a good roll and go down in price, we'll do that. Now, when you roll a position down, it's helpful because it's freeing up more cash in your portfolio that's being held for the trade. For instance, if you had a $100 strike price on a sold put, then your broker is going to hold out $10,000 for you to take assignment of that if in fact you were assigned. Well, if you reduce your strike price and go a little bit further out to, let's say, $90 a share, now that is going to release another $1,000 into your account that you can do something else with. So rolling down is preferred, especially if you can get a credit when you roll down. Now, here's the positive part of early assignment. If you're early assigned a stock, well, you get to keep all the premium that you received when you took out the trade, and you just get the stock earlier. So if the stock is going to rebound, then you will have the advantage of being able to be nimble and work with that trade. Either you can put a trailing stop loss on it, or you can run the wheel strategy and start selling covered calls once you can get a little bit of premium above your strike price so that you're not taking a loss on the trade. Now, if you push your trade further out in time, you're going to get more premium. That actually helps you if you're early assigned, because if you're pushing your trade further out, any extra premium you get, it's yours to keep as long as you don't buy yourself out of the contract. So if that's the case, then you are quietly stacking dollars on the side. And if you happen to get early assigned, well, you can use all the premiums you received, the initial premium and then the extra premium for the roll. You can use that to help reduce your cost basis. For instance, if you sold a put at a $100 strike price and you ended up rolling that a couple of times, and in that process, holistically, you collected $20 in premium. That lowers your cost basis on that stock to $80. So even if the stock is sitting at around $80 after assignment, you can, with confidence, move forward and start selling covered calls. It's little tips and tricks like this that help make option selling a little bit safer and easier for you to control than if you're just buying the stock outright or if you're buying a short-term call in hopes of the stock going up. Let's go into the computer. I'm going to show you a real example of what I'm talking about. So we have a sold put on Palantir right now, and we are going to be rolling that down and out. So let's take a look at the technicals so we can get a better sense for how this may help us. Currently, Palantir is trading at around $80. The bottom of the Bollinger Band is closer to about 63. The 200-day moving average is as low as 52, and some are suspecting that it could get down that far. So you want to reduce your chances of early assignment with that much of a gap from your strike price. Our strike price that we have right now is closer to the middle of the Bollinger Band. So we received a premium initially when we sold this, but now that it's dropped so much, because it's been several weeks since we took out the trade, now we want to roll this trade down a little bit closer to the potential price that it may drop to. That will help us reduce early assignment. Plus, it is going to help us stack premiums that will help insulate us if we are early assigned. Let's take a look at the holistic picture of Palantir, though, to ensure this is still a healthy company to be investing in. For that, I go to the Analysis tab, and this really tells me a lot of information. Let me explain. First of all, if you look at the earnings section, you can see they continue to outperform earnings. And Yahoo Finance has this great little feature here where they have an estimate on where they think they will be for their next earnings on May the 5th. So it looks like they will more than likely meet the earnings expectation. Also, when you look at the revenue and the earnings, this company is making profit. You can see that their revenue is growing, so that is good. What would make it even more enticing is if you see that the amount that they're bringing to the bottom line, their earnings was growing as well. So it had been growing for quarter 1, 2, and 3, and it looks like it did not keep up with the revenue push. So you would want to see in the next quarter that this would start to increase and more closely match the stair-stepping up that we're seeing in the revenue. And if you look at the analyst price targets, you're looking right at about $86. And so the current strike I have is above that. But again, my goal would be to try to get down to a fair amount for the trade after I stack premiums. If we look at the specific trade that I'm interested in rolling, let's see what happened. So this expires on March the 28th. It's a $95 put. We may get up there, but we may not. This was taken out back in February when Palantir was trading much higher. I was paid at the time that I took out the trade $2.71 in premium. So that right there helps insulate me a little, but it's definitely not enough to overcome what we're seeing right now. And that's about a $15 difference. So we want to do everything we can to gain more in premium while making our trade a little bit safer. So what I have decided to do is I'm going to roll the trade, and the goal would be to get more premium for rolling the trade and try to go lower in strike price. So let's see if we can accomplish that with this particular move. When you get to the order ticket, if you select roll, it will auto-populate the template that you need to start putting in your position. So right now, this one is expiring on March the 28th. And again, it's the $95 put. Currently, it's trading at around $16.40, but remember, I just received $2.70 for it. So simply to get out of this trade would be very expensive if I didn't have a replacement trade. So here's the potential move. I want to push significantly further out in time to allow for the market to rebound and maybe have a few more earnings reports that are good for Palantir and help the stock recover. So I've selected September the 19th. It's much further out, but I will be paid for going this much further out. Also, I want to come down in strike price. So initially I had the 95. Now I'm going to select the $90 strike price. In here, you can see that there is going to be a substantial credit if we roll out, and rolling down is going to help make my trade more equitable for me. So let me show you the particulars. I would be getting out of the original trade by paying $16.40. But I would sell a new trade, and that new trade is going to make my trade safer by coming down $5 in strike. And I am going to receive more than I paid to get out of the other trade. As you can see right here, the midpoint, I'll receive something around $21.80, and I get to keep the difference. So right now, it's auto-populating for me, $5.48. Well, the way you understand that credit is you multiply this by 100. So I will actually be receiving close to $550 to make my trade safer and insulating myself against the perils of early assignment by stacking premium. So I went ahead and auto-populated it based on the midpoint, and it does look like I will be receiving about $546 additional premium if I make this change. And let's take a look. Yes, it did fill, and it gave me a little bit better. It gave me a $5.48 premium. So now let's look at the different scenarios that could present themselves, and we can see how this put me in a better position. If we consider the original trade with the $95 strike price, I received $2.70 credit. So if I were put the shares, that would make my price $92.30. That's my adjusted cost basis. Now, let's look at the rolled situation. So I received the initial $2.70, but I then received a credit of $5.48 when I rolled the trade. That gives me a total premium of $8.18. Now we take our new strike price, which is $90, and we subtract $8.18. This makes my new cost basis $81.82. Now, this is a lot better situation for me if I'm early assigned because I had the extra credit to insulate me, and this puts that price at a much more reasonable level. Now, if Palantir were continue to pull back, I can continue to roll this trade out as far as I need it. But do keep in mind you are tying up your capital for a much longer length of time when you do this. However, if you plan to hold onto the stock in your long-term portfolio, it would actually be more accretive to you to roll it out, take this little bit of extra time, and get it at a much lower price point. Everyone stay safe out there. I hope you found this helpful. Remember, if you're with me trading with Ashley, there is no trader left behind. Now, I did a video on rolling a trade a few weeks ago. You may find it helpful. It discusses the benefits of the delayed roll. I'm going to post that video for you right here.